The banking crisis rages on. In today's video, we're going to look at everything, including the Federal Reserve and the actions they have taken right now. This is brand new information, and I want to bring it all to you. So what we're going to see is that the Federal Reserve is trying to actually stop the crisis, but they can only do so much. The Treasury has their own things that they've got to do and started to do, and I want to show you all of that. You have to understand your cash, currency, credit is being tossed into the incinerator, into the fireplace, and we are getting every single day getting a worse and worse scenario as it relates to our savings and to our purchasing power. So I want to bring that to you. You came here for the truth, so let me unveil that for you. Look at the balance sheet. You can see what has happened over the last little while. The balance sheet was expanding up until a certain point, and they started to do their quantitative tightening. Well, now as you can see, the past 2 weeks, this is now the second week in a row where the balance sheet has expanded quite a bit. If you look up Fed H41, that's going to give you the breakdown of all the different facilities that they have. And I've shown you that many times on the channel. And if you stick with me, I will do an entire breakdown of that in a separate video. But it will highlight the fact that mortgage-backed securities, treasury securities, those are going down still. However, the Federal Reserve has this new facility that they've set up so that the banks can utilize that. And I want to break that down right here today for you. So if you pay attention to this, you're going to understand exactly what's going on and why. You know, this really shows us that there is so much turbulence right now in the banking system. I think it is very clear, and this is just one example of that. You have seen so many different banks that have gone into crisis mode right now, not just SVB, there have been several. And that really highlights how dangerous, how fragile and frail they are despite all these, things that they put in place. Oh, we do the stress tests and all these things. Oh, we didn't see it coming. They never see it coming. They never see it coming. They said the banks are well capitalized, so much more than 2008. Here we are, okay? So this is it. Banks are still drawing on the Fed for $164 billion of emergency cash. Big stuff, right? Well, I think people should be aware. You see, even though the banks reduced their borrowings just a tiny bit from 2 Federal Reserve backstop facilities, it seems like they're still taking full advantage of the central bank's liquidity. The Bank Term Funding Program, I talked about that in a previous video, BTFP, saw outstanding borrowings of $53 billion. That's up from $11 billion the previous week. This program was launched on May 12th after the Fed declared emergency conditions following the collapse of Silicon Valley Bank. If you were here on the channel, or I'm sure you're aware already, you saw how that went through. The Federal Reserve came in and said, we're going to make sure that everything is A-OK. So we're going to put this facility in place, and that's going to stabilize things. At least that's what they said. Even though funding markets have been showing some signs of stress, pressures have subsided, supposedly, with the take-up of these emergency measures. But there's still concern about whether deposits will keep fleeing from banks for other places in the financial system. Money market funds have been scooping up cash lately. I believe I have a chart to show you today. And it's mostly because of depositors pulling their money away from these US banks. So what does that tell you? If they're going here and they're putting their money, taking it out from here and putting it somewhere else, they don't have faith in that. That's really what it signals. Now they can easily, with a couple buttons, couple keystrokes, they can move that back. But I think it's important just to highlight what it means. Fed Chair Jerome Powell and his colleagues raised the benchmark lending rate. So the Fed funds rate went up by 0.25%. But when asked if this would actually make the problems worse within the banking system, Powell said that they're focusing on financial stability tools and lending facilities. So it seems like they're still trying to tighten up, and hopefully they can give that liquidity through these other measures and not have to really worry about changing their tune when it comes to putting down inflation using higher interest rates and the quantitative tightening. So that's the explanation here. I hope that you understand really what's happening. I think it's really complicated, but when we can just break it down here, I think it becomes a lot more simple. Now, we got to look at the next aspect here. I want to shift gears. Let's talk about interest rates that are going on around the world, specifically the UK. Bank of England raising interest rates by 0.25%. There are concerns it might not be enough to keep inflation in check. So many people are saying, yeah, you're not really fixing the problem here, okay? Inflation is super high. It's not coming down. You've been increasing rates. The ECB doing the same thing. The US banking system facing turmoil, Moody's warning of potential risks. So we got to look at how money market funds are kind of seeing the benefit of all of this. It's really good stuff when we break it down and start to understand it all. Okay, it makes a lot of sense. And you could look at the central banks around the world, and it might be small fonts for you, but you can see American, Australian, and all the way down, US. From everybody from US to Turkey and everyone in between, you can see those red arrows. And that's basically showing that the interest rates are increasing. And then it has the date on the right-hand side there. For the most part, they are increasing. China has decreased. The last time was back in 2022. And so you could just look at this and what these central banks have been doing. In general, most of them are tightening. Okay. So we look at that and have to kind of get an idea of what's been happening, and you realize tightening financial conditions from many different avenues. And this happens to be just one, and that is the Bank of England increasing by 0.25%. They did the same thing as the Federal Reserve, increasing by 0.25% as well. Now here we go. This is where it gets fun. This is the cost of insuring against Deutsche Bank default. So you measure that in CDS, that's credit default swap. And for anybody interested in credit default swap, if you ever want, just for fun, type in CDS Greece. And you're going to get some interesting articles that I was covering here back on the channel about a decade ago, where we looked at all of that. And it was messy, to say the least, because they were using it as a tool to actually punish the country in a sense, where things just get worse and worse because there's always speculators looking to profit on the way up and the way down. So here you can see, once again, just looking at this. And what does it tell you? Well, essentially, perhaps the question is that the market believes that maybe Deutsche Bank will be the next one in line. I've been talking about this for a while. There is some serious concern. If you remember a few years ago, they were trying to combine the two biggest banks in Germany to have Deutsche Bank and Commerzbank become one. That didn't happen. Just like they really tried real hard for UBS as well. So, Credit Suisse and UBS came together. I don't think a lot of people like that move, but that's what happened. It's like, what do? You take the garbage from this thing and you shed it off, you fire a whole bunch of people, you get rid of it, all the bad assets. You take the good pieces and you stick it in with that other company and you get an even bigger company. And those massive companies, they don't really care about the people. We know that, right? The big companies sometimes are not the very good things that we want, but they're doing it anyway, and they're using this as a way to get away with it, I guess. Run into US money market funds continues. Assets rose by another $117 billion in the past week to hit an all-time high. So what do you think? What does that do for you, right? When you look at this, you can see, number one, Federal Reserve is hiking rates, and as they do this, more money can fall in there. People want to keep their money in US dollar, and they also want it to be very liquid because they're worried. That's what this signals. That's the takeaway for you here. Then we have this, just showing you, if you look at the inflation in the UK over time, measured in two different ways. Buying power of £100 over time from 1800 till now kind of looks pretty terrible. And then as well as the inflation rate too. So you measure it in different ways and tells a story. Moody's sees risk that US banking turmoil can't be contained. Still, the agency baseline views that the U.S. officials will broadly succeed. I love that. Well, we can't contain it, but we're going to succeed because we can't say anything else. I don't have anything to say about these agencies, but I'll tell you right now, I wouldn't put too much weight on them at all. I just think it's interesting because it's related to the video here. All right. Now, we got to look at all of this and take it in and understand what's happening. We see the banking system and the banks specifically just having some serious troubles. And the Federal Reserve is trying to come out there and they're trying to backstop it all. In the end, they will devalue your currency to do it, by any means necessary. And what some people don't realize is they need to study only one thing, and that is if they type into a search engine, Bernanke 2002 Fed speech. You read that thing right through, it's not that long, 2002 Fed speech, Bernanke, and you're gonna see it for yourself. In that, he said deflation, making sure it doesn't happen here. That's the name of the speech. And I've read that multiple times. I've shown it multiple times. And what does it tell you? It means that they are willing to do anything, including, as he said in that speech, devaluing the currency 40% if it means that we don't have deflation. This is what they're going to do again and again and again. And it all is really ending up on your shoulders. They're going to do this. And they're going to essentially devalue your currency into confetti. I don't know how to say it any other way. That's the way it goes. So what do? Learn about the pillars of prosperity. I put it up for reasons obvious, and I hope that you will learn about that. Just search Pillars of Prosperity, the Money GPS, and you're going to see that. And of course, if you haven't already, you got to become an insider. Every single day I send you the video of the day. That's all it is. It's an email sending you the video of the day, and you get on the insiders for free. It's available at themoneygps.com. Scroll down to the bottom of that website right there, fill in your email address, and I'll just send you the video of the day. That's it. I'll see you tomorrow. Take care.